As central banks continue to raise interest rates, money market funds look increasingly attractive. So in this video, we compare the income on money market funds with those of typical savings accounts, and that's both in the UK and the United States. Now don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. So let's look at how to earn rising rates using money market funds in a bit more detail. There have been headlines recently about bank deposits paying very low rates of interest. And in the UK, the Treasury Select Committee has investigated this. And here's a quote from one of the members of that committee, who's Dame Angela Eagle. And what she says is, in the middle of a cost of living crisis, the high street banks are squeezing higher profits from their loyal savings customers. And she describes this as profiteering. But this misses a key point, which is that, of course, banks see your deposit as a very cheap form of funding. And if you're not going to lock in that cheap funding for a period of time with a term deposit, then they're not going to incentivize it by offering you a high rate of interest. If you do lock in the funding for longer, they will offer you a higher rate. And in fact, it's very easy to earn those higher rates, which we now see in the UK and in the US and elsewhere. A key thing to understand here is that the period of time you lock in your money for affects the return that you receive. And at the moment, we're in a very special situation where if you lock in for a short period of time, you actually earn more income than if you lock in for a longer period of time, despite that being more risky. So this inverted yield curve is great for savers. It means you can have low interest rate risk. You don't lock in your money for a long period of time at a fixed rate, but you can earn pretty good returns. And that's true of the UK yield curve, that's the top panel you can see here, and it's true of the US yield curve. Furthermore, as inflation's turned out to be very sticky, you can see that the short end of the curve has carried on increasing, which is great news for savers. Now, it turns out there are many ways to earn the short end of the yield curve. For example, you could buy short-term government bonds, single bonds. This is pretty complicated, it's certainly not for everyone, but it's something I've done recently and I've made a video about it for our members. Alternatively, you could buy a short-term government bond fund, which only buys those short-term government bonds, and that way you can earn the yield on those bonds. The third choice, which we'll look at in this video, is you could buy a money market fund, and this buys ultra short dated instruments. But of course, you could also go down the bank route and you could look at a certificate of deposit in the United States, or you could look at something like a fixed term savings account in the UK. All of these will give you variations of earning that short end of the yield curve. Now, why would you choose money market funds? And certainly if I'd asked that question in the past, for example, in the period between March 2020 to December of 2021, you can see that money market funds, that's the ticker VVWDC, which you can see here, earned almost exactly zero. That was at the same time that we had a huge rally in stocks after the pandemic sell-off. So while money markets were earning zero, stocks were earning around 70%, and that's for a globally diversified fund. However, the picture looks very different now from the end of 2021 to the time I make this video, which is summer of 2023. During this period, global equity has actually been trading sideways. It's actually down a little bit as I make this video. In contrast, however, money market funds have been earning an accelerating rate of interest, and overall they've made about 3.3% over that period of time. Now, another way of earning that is with cash ISAs in the UK. For example, at the moment, they're earning around 5% or even higher. However, those are going to lock in your investment for some period of time, and there'll be penalties if you take out your money before that period's up. Whereas with a money market fund, you can sell the fund at any time you like. Also, it's usually held in a stocks and shares ISA. So let's say you did want to reallocate to stocks, you can do that literally in the matter of a few hours, or perhaps at most over the course of a day. In the US as well, you can earn higher rates with savings accounts right now. So here are some examples from bankrate.com. And you can see that these rates are pretty good. Some of them are almost as high as 4.8%. However, if you look at the fine print, they do come with some drawbacks. There usually are some constraints in terms of the minimum deposits. And of course, you usually have to have a bank account with a bank in order to benefit from those rates. So again, I think the primary benefit is that you have more flexibility with a money market fund. You don't have to have an account with a certain bank. You don't have to lock in your investment for some period of time. As soon as you put your money into the money market fund, you'll instantaneously start earning whatever the short end of the yield curve is paying. If you want to learn more about investing and keep track of what's going on in markets, then why not sign up to our free weekly market roundup? It's published every Friday, it's short, it's punchy, and we try to keep it entertaining. So if you want to learn more about that, just click on the link in the description beneath me. So what's in a money market fund? Well, the clue's kind of in the name if you look at the one from Vanguard in the UK. It's called a Sterling Short-Term Money Market Fund, and if you look at the weighted average life of its investments, you can see that they're very short, a month or less. That means that as interest rates increase, there's a continual churn of assets which are maturing, and new ones will be bought which pick up the higher rate of interest. So if you do think interest rates are going to carry on increasing, this is a good way to pick up those rates very quickly. Now for the UK version of the Vanguard Money Market Fund, you can see that almost a half of it is invested in commercial paper. These are short-term IOUs which are issued by companies in the UK, and they will be chosen to be high-quality issuers. So it's unlikely these companies will default. But there are also time deposits, there are UK Treasury bills, so these will be very short-dated UK gilts, and also certificates of deposit. If we contrast that with a Vanguard Money Market Fund in the United States, notice that 58% of that is invested in repurchase agreements. So these will be loans to the Federal Reserve, which has lots of US Treasuries. In return, the Federal Reserve provides the Treasuries themselves as collateral. So think of this as a form of collateralized lending to the Fed. About a third of it will be in short-dated US government obligations, and about 10% is in short-dated US Treasuries, or T-bills as they're called. But again, the lifetime of these investments will be very short, so that as they mature, there'll be new ones bought which pick up the higher rates of interest as the yield curve shifts higher at the short end. So now let's look at the return which we'll receive on these money market funds. Now in the United States, there's a really useful measure which is published for every money market fund, but it's a 7-day SEC yield. The way to think of that is that it's kind of like an instantaneous income which you'd receive right now by buying the fund. So if I click on the definition, here it is, you can see that for a money market fund, it's calculated by annualizing its daily income distributions for the previous 7 days. Now for the UK, we don't have an equivalent of the SEC 7-day yield. So what I've done in this video is to calculate it for you. Now fortunately, what we do have in the UK is money market funds, which are accumulation funds. In other words, the income is instantaneously reinvested into the fund and increases its price. So for example, if we look at this BlackRock money market fund, you can see its price since 2000. During periods when interest rates are higher, you can see that the gradient is also higher. That's the rate of increase of the price of the fund. And that's because of the reinvested income. However, during the zero interest rate period, you can see that it was almost a flat line. Since inflation's been high and the Bank of England's been hiking, you can see that the bank rate, that's the policy rate from the central bank, has increased. So has the sterling overnight index average rate. That's the rate that a lot of these money market funds use as a benchmark, which is very close to the bank policy rate. As that's picked up, you can see that recently, so has the gradient of that money market fund's price. So what I've tried to do here is to reproduce that SEC yield, but for UK funds. What I've done is to look at the 22-day change in the price of each money market fund, and then I've simply annualized that rate of return. So the yellow line, which you can see here, is the SONIA overnight index average rate for the UK, and the light blue line you can see overlaid on it is the annualized rate of return on this BlackRock money market fund. Now what's noticeable is that the BlackRock fund is keeping track with that SONIA rate very closely. In other words, as rates have been increasing, so is the income on the money market fund. So all of those concerns about profiteering by banks are kind of irrelevant as long as you're able to buy one of these money market funds. And as long as rates carry on increasing, you can almost instantaneously pick up the higher rate by buying one of these money market funds. And it's not just that BlackRock fund which has tracked SONIA quite closely. Here I've shown 6 funds, including the BlackRock fund, and you can see all of them, some more closely, some less closely, have tracked SONIA over this period of time since 2020. So really there isn't much to choose between these funds. I just probably choose the one which has the lowest fee. Now I know some platforms don't give you access to those accumulation funds, so in that case you'd have to buy an income fund which pays regular payments into your brokerage account. Now to annualize the return on these funds is slightly more tricky. So for example, this ERNS fund from iShares only pays every 6 months. Now you can see the size of those payments here beside me, and they've certainly increased a lot recently. They've gone from about 50 pence every 6 months to just under £2 for the latest payment. So if we wanted to annualize that, we could simply assume that that's going to stay at £2 for the next 6 months to give us a total of about £4 per unit that you buy. Each unit costs £100. So the rate of return is currently around 4%. In fact, it's just under 4%. In fact, what I'd expect is that the next dividend will be even higher as it picks up the rising rates in the UK. So probably the yield will be close to around 5%. But again, these income funds will be buying the same things as those accumulation funds, and they'll be buying those very short-dated UK instruments and generating similar yields. So what are the risks with these money market funds? Well, probably the biggest risk is that you stay with them for too long. Remember, over the long term, these things will underperform as stocks. Looking back over a period of 120 years, stocks have beaten inflation by around 6% in the US on average every year, whereas your average US Treasury, with a maturity of around 7 to 10 years, that's beaten inflation by around 2%, just under. On money market fund instruments, in other words, US bills, very short-dated US government bonds, have only just beaten inflation by 0.4%. So the real risk here is you stay cautious for too long. Remember, money market funds are just short-term places to park your capital. But if I were to identify a single big risk for money market funds, I'd say it's something to do with liquidity. Now we saw that for the UK version of the money market fund, the Vanguard one, it actually bought quite a bit of commercial paper. These are corporate bonds, effectively, with very short duration. Now, if there is a deterioration in the quality of UK corporate bonds and we see more defaults, then that market could become illiquid. If those downgrades happen, then money market funds may be forced to sell that commercial paper, and forced selling would push down prices and create this downward spiral of further downgrades and further illiquidity. And if there was a stampede out of money market funds, it's possible that they couldn't sell this stuff quickly enough. So they certainly don't come with no risk. I'd say there is a risk with these money market funds. It's just very low compared to, say, equity funds. So what are the choices in the UK if we look at money market funds? Well, here are 8 of them, and these are some of the largest ones, and I've restricted it to the ones with the lowest fees. You can see quite a few of them have an expense ratio of 0.1% or lower. Some are accumulation funds. I probably prefer those because you can see the instantaneous rate of return. But if you can't buy those, then there are also the income funds, which give a similar rate of return. And if we look at funds in the US, there's actually quite a lot more choice. And one of the largest is that Vanguard Federal Money Market Fund, where the expense ratio is just 0.11%. The minimum investment is $3,000. But if you did want a money market fund without a minimum investment, there's always the Fidelity Money Market Fund, although the expense ratio there is higher. So if you do think central banks are going to be raising interest rates for some time to come, then money market funds offer a fairly low maintenance, low fee way to earn that rising rate of interest. Now don't forget, if you do enjoy our content, please subscribe to our channel, and also don't forget you can sign up for our free weekly market roundup, and that way you'll get timely news delivered to your inbox every Friday. And, as always, thank you for listening.